Good evening, ladies and gentlemen. Welcome back to Walk the Block. We're navigating digital finance all together. Got a fun little show for you here tonight. We had some major developments coming out surrounding Jane Street and the two kind of nefarious things that they've been allegedly doing. Gotten sued by two different people on that front. But pretty much one is a tale as old as time, which is that stablecoin depegged and broke a centralized exchange. And then the second one is classic market manipulation. And well, we kind of have some decent receipts for that one, and we're going to be talking about what the implications of that is now that it appears to be over. Outside of that, we also have a small update on the Clarity Act. That is the market structure bill going through Congress at this time. And more importantly, though, we got some more data. We got the ISM numbers coming out today, and we're also going to get the Chicago PMI numbers on Wednesday. So that's a good one to watch out for. But the numbers that came out today, I think, are going to be a very, very pleasant surprise. We're going to be breaking down all that and more here tonight on the show. I'm your host, Zenith. As always, it is a pleasure to be with you guys, and I'm joined by my co-host, Tracker. How you doing, buddy?
Doing all right, man. Doing okay. Looking to get into everything. Missed last show, so I'm definitely ready to get into this, start talking. I always feel like if I'm not here and get my weekly fix, man, I feel off the rest of the week. So definitely like to be in here. I mean, love to talk about the various things that are going on and try to keep everybody up to date on what's happening, what things we actually care about, what we don't care about. And the other thing, just for everybody who's out there listening, if you guys have any questions or anything, post them in the comments. Let us know your thoughts. Anything. I mean, we can't see everything. So if you guys are seeing stuff or hearing about stuff, yeah, let us know.
True.
Looking forward to get into it.
Yeah, we got our buddy Centurion 54X in there already. He says, "You guys enjoying the fireworks?" I imagine you're referencing all the stuff that's been going on in the Middle East lately. Yeah, to a degree, I am, but at the same time, I think there's an interesting point on that one for the folks that caught the DJ Roundtable show yesterday. We talked about how in the past, whenever there's kind of these international incidents or spark point moments, the markets usually react rather negatively. But if you look at the charts, they didn't move an inch really. So could be just the new normal now. Who knows?
You typically get a knee-jerk reaction sell-off because of the uncertainty. It happens. People start to dump. Anytime there's any type of a big event like this, markets tend to dump, figure out what's going on, and once they have clarity on what's going on, then they reposition themselves or either back into their positions or position themselves into to take an account for what may has changed recent landscapes. But it's pretty normal. And me, Zenas, we're talking in the green room. Typically now, back in the 80s and 90s, it took a lot longer for people to unwind what in the heck was going on, understand really what's happening. This day and age, saw this moving so fast. You're probably more concerned about getting fake information than real information. So we probably just got to go through some of that first to figure out what's going on. But a lot of these institutions have so much information and so much of an edge on information that's going around. They typically get the information that they need to know to basically get back into positions or get more defensive. And the fact that everything snapped back, it's pretty common.
There you go. Yeah. I actually got the charts ready to go on this one. So give me one sec. Obviously, the Iran strike was major news event, but wasn't really planned for this show because we got some bigger fish to fry. But got the S&P 500 here. You can say on the day we opened up, gap down, but closed actually higher than where we closed on Friday. And then additionally, if we flip over to the old Bitcoin, not much going on. You could argue that this candle right here is all of the volatility that happened, which was a swing from 67 to 63,000 in pretty much the same exact trading range that we've been in for the last week or 3 weeks at this point. So I'm just saying, I think this one really didn't move the markets that much. I think to your point, Tracker, I think a lot of people were able to kind of make sense of the situation quickly and understand what exactly is going on. And to a lot of folks, honestly, based on the chart reaction, it seems that the market kind of either anticipated this or just didn't care.
Well, I mean, I know we were talking about this in the green room too. What did I call the poly market, the different tools and different betting that can forecast
prediction markets.
Thank you. The prediction markets. Prediction markets are basically this new tool that people can start to bet on. This is where potential inside information can get leaked out, and people are taking advantage of it. So there were some big bets getting put on this, man. and it kept bubbling up. I mean, we were hearing about, rumors that Iran was going to be in the mix right after the invasion in Venezuela. They were already talking about this, already starting to spin it up, and so this one kind of felt like a lot of people saw it coming. It's unfortunate. I mean, it really is, because come on, nobody needs to warn and stuff like this. I mean, it's horrible, but the prediction markets were definitely doing it, and those are actually getting a lot of backlash now. It's starting to get mainstream. Certain politicians are grandstanding on that, saying this is unacceptable, this is unethical, that people can profit off of this, and whether you agree or disagree, it's irrelevant. If people want to gamble and put their money into it, and you're not going to stop these predictable markets. You're just not. If we shut them down, other countries are going to spin them back up. So we live in interesting times, to say the least.
Yeah, my response to the people that are crying out, people profited off this warlike move. What is going on? I have a response for you. First time.
Right. Yes. I mean, a lot of people have been profiting off the industrial war complex for quite some time now. So,
Yeah.
I mean, if you own defense stocks, you own all these things. I mean, you essentially are, betting money that these are the reason why they're going to do it. Just like if you were to put your money towards tobacco products or any type of products that are bad for other people. Once again, when you're an investor, ethics kind of go out the window. I mean, teach their own. I personally don't own those. I don't own those things, but if you do own them, a lot of people in a lot of institutions will tell you, you're not trading on emotion, you're trading on what potentially is to make money, and that's what you're doing. So
that's true. I think the prediction markets are a unique thing that's come out. It's nothing crazy, fundamentally revolutionary, but it is a much larger and a much hungrier market, it appears, to kind of start betting on and predicting anything and everything. And well, this definitely falls into the category of that. It used to be just, who's going to win the sports ball game or who's going to be elected president, but now we're getting a lot of stuff, and it's some real odd stuff, but I think that prediction markets are probably going to fall into the crosshairs of politicians and the mob at some point in the near future here. But at this point, to be honest with you, I think the cat's out of the bag on this one.
Yep, can't put it back. And to go further into that, people are going to bet on what they want to bet on. Period. Money's going to go where it wants to go. You can't really tell people that. I mean, the predictable markets are really interesting. Now, the one thing you can do as an investor that you could definitely look at is, if you, on these predictable markets, if you could, and I'm sure people are already doing this, the smart institutions, they're putting those alerts in place to see if there's any unusual activity. As soon as it comes in, that's probably then having them putting certain bets on to basically piggyback those bets. Because, I mean, if you get unusual activity, that typically means that something's about to happen. So it's interesting.
Yeah, that it is. But to be honest, it's nothing too crazy or revolutionary. Alrighty, tell you what, let's jump into the main thing that we have prepared for everyone this evening. Coming to us from Forbes. I got one of my 3 free articles of the day pulled up here. Thanks, Forbes, for that. You're at least better than the Wall Street Journal, so thank you. Jane Street, 2-continent problem, barred in India and sued in crypto. We have a story of 2 tales here, but about one similar entity, so let's dive into it. Within days of being sued over the $40 billion Terra collapse, Jane Street Capital was rumored to scrub every post from its X account. Rumors turned out to be false, according to the Wall Street Journal. Page never had posts. Nevertheless, crypto market participants are on the edge as the firm, which generated $20.5 billion in net trading revenue last year and handles roughly 10% of all U.S. equity trades, now faces allegations of inside trader crypto markets. It is not the first time the quantitative trading firm has been accused of exploiting privileged access to extract outsized profits. This lawsuit came in the Southern District of New York, alleging that they used inside information from Terraform Labs to avoid more than $200 million in losses before the Terra Luna ecosystem imploded in May of 2022. Jane Street has called the suit desperate and a transparent attempt to extract money, but the allegations land differently when read alongside the 105-page enforcement order that India's Security and Exchange Board published last July, documenting what they described as a strikingly similar strategy on the other side of the world. So, Two stories we're going to break down here. Number one, what exactly went on with the Terra Luna collapse? Number two, what exactly is going on with the insider trading? First off, let's talk about the Terra Luna collapse. For this one, I have a bit of a summary from Axel Bitblaze. It says, all right, here we go. After 4 years, Jane Street is now getting exposed, and he is furious. Quick walkthrough. May 2022, Terra and UST, their stablecoin, collapses. $40 billion gone in 3 days. People lost everything. Life savings, retirement accounts, gone. Now, we have some receipts saying that Jane Street's going to be behind it. Pretty much what's going on is a former intern named Bryce Pratt joined Jane Street in 2021. He funneled insider information about the liquidity moves to their trading desk. In May of 2022, Terraform quietly pulled $150 million from their curve pool. No announcement, just silent withdrawal. 10 minutes later, a wallet linked to Jane Street pulls $85 million from the same pool. This is over the course of 10 minutes. What this did is it triggered a depeg of the stablecoin and initiated a death spiral. Luna went from $80 to basically zero. $40 billion of that market evaporated almost instantly. That crash killed Celsius, Three Arrows Capital, and eventually something similar with FTX. 8 billion in FTX customers gone, and that is a separate story that we will get to here in a second. And that one is the reason why SBF is in prison for 25 years. Jane Street made record profits out of this, and they had 24 billion in revenue just in the first 9 months of 2025. All right, pause right there. First one there, Terra Luna, back in 2022, one of the leading central exchanges in the marketplace, and then it almost appears that overnight they collapse. There were some warning signs from people earlier on in the year saying that things are looking sketchy, you might want to get out, but the official date of the collapse was in May of 2022. And yes, guess what it was by? A stablecoin that they owned, tied to their own token that also was propped up by said stablecoin. So when you lose the backing, you lose the crypto. When you lose the backing of the crypto, well, it's held up by nothing, and then it kind of goes to zero. Thoughts on that one? Does that seem fishy at all?
No, not at all, man. Just regular day in crypto, man. Well, it goes back to what we keep saying about crypto, and that is it's such a small market cap overall. It's and back then it was even smaller. So these big institutions that have control these massive amounts of money, these whales essentially, institutions can make these market moves happen. And when they saw the chance of a low liquidity by pulling all that money out of the pool, the liquidity pool. So liquidity pool is, for those at home that don't understand this, for people to trade, buy and sell, the price is set at a certain point. But if there's thin liquidity, meaning there's not a lot of free cash tied to it, when you make the trade, it causes what's known as slippage. So you come in with these big, massive orders, and if there's not enough liquidity in the pool, it will just keep dropping the price because it's got to drop to these levels to pick up all the other liquidity to fill the order. It's kind of like I want a whole dump truck worth of sand, but I've only got a sandbox worth of sand. Well, if I'm going to scoop up that sandbox, I'm going to have to dig so many, and just to fill my dump truck, I'm going to have to go past the sandbox. I'm going to have to dig even deeper into the ground, leaving a massive hole, not just sandbox. I got to dig everything out to fill up that dump truck. So it's much more disruptive than just you filling that sand. You know, that's a simple analogy. It's just that, so by doing that, all of those sell and buy orders that people have on the markets, those all get triggered, the sell orders, to basically push it down, and that causes a liquidity drop. But by doing it so aggressively and causing so much of we'll call it a sell order on something or a buy order on something, it will then cause that price to just plummet quickly. And when it does, it causes a massive trigger effect where it just will literally send that price to zero, and it just spikes down. It liquidates a lot of people. Then it slowly started coming back a little bit, but then it was just a trading at that point, people to get in it. But once again, the story here is this: you got to be really careful. We've always talked about this when you're looking at these pools, how much liquidity is there? Because that liquidity is how much activity can that pool handle on trading. And back in 2021, 2022, and all these other, these central exchanges don't have a lot. So hopefully these new bills that come out will start to also push to make sure that there's enough funding behind these. Now, one thing that they've done is they've created a ton of stable coins and stuff that's been backing it. So I expect there not to be thin pools, at least on the major central exchanges and stuff like that going forward. But you can just see it. But once they had that inside information that they knew how thin the liquidity was, now they could just push that price down aggressively. So they certainly, their goal was, it's very clear. They wanted to destroy the price and depeg it, and they were going to profit off it. And it clearly showed how much they made on it. So one could state that they did that and it caused this crash. At the same time, they could come back and say, well, it wasn't our fault that this thing was poorly funded in liquidity, you know, they could say that it wasn't set up right. So you could have that argument in case too. Their judges could, or their lawyers will probably come back with that argument. But I also find it interesting, a lot of their social media things that they had posted over the years, a lot of stuff had been disappearing supposedly. So they've been kind of cleaning up behind themselves. So there's definitely some things going on there. But the moral of the story is be very careful when you're dealing with any of these pools and money when it's on central exchange and stuff like this. And this is what should happen. Now, Zenas is going to keep going in his article, and you're going to see the ripple effects of this whole thing, though, because it didn't just stop there.
That's true. The second part of this article, I'm actually going to save for a little bit later because this actually sparked a little trip down memory road that we want to present to everyone out there so that this stuff does not get memory hold. So, 2022, we also had another similar event happen. This one was FTX, the one that we talked about as well. So, Terra Luna happened in May. FTX was October, November timeframe. I believe November is when the second shoe really dropped on it. That one, sort of a similar story, but a lot more nefarious when it comes to, criminal action that was actually proven in a court of law. So, summary of that one is it was one of the most consequential failures we've had in crypto history. Keep in mind, this is after they just ran an ad in the Super Bowl, by the way. But they filed for bankruptcy after customer deposits were allegedly commingled with a sister company, Alameda Research. That's the group that Caroline Eastman was part of. And then she was working with Sam Bankman-Fried through FTX, borrowing customer funds to rebuy up their own token to prop up the price and keep it going. Once another billionaire, CZ of Binance, actually did an expose on them on Twitter saying, hey, there is less than 0.5% of the token actually out on the open market. And there is a very high chance that about 95% of that token is still owned and controlled by FTX, meaning that there's 4.5% that is either not released yet or is actually traded by the public, making this a very, very artificial market. As a result of that, there was kind of a bank run dynamic. A lot of people sold off, dropping the price, pretty much causing these guys to go into liquidation crisis. Typically, you kind of think about that when it comes to options and whatnot. But realistically, the liquidation here was they were underwater on their own token that they borrowed other people's money without them knowing to go buy.
Correct. That part, yes. But the run, excuse you, the run started when CZ and them decided, when they saw that, they started dumping the FTX coin. They didn't like it, so they dumped it. That caused the cascading effect, but they didn't realize that it was going to be as bad as it was. People were like, well, that's very no, that's horrible that CZ just dumped on them. But keep in mind, remember there were shots fired on FTX's side toward him too, going into that. But CZ was like known as the best guy in crypto. Like he was really navigating through all these storms like you were seeing throughout crypto industry. Anyhow, he felt bad after that happened. Within a few days, he said they were going to come in and save FTX. So they were going to buy it up, and they started looking at the books and everything. And it took them less than, 48 hours. Like, yeah, I think we're going to pass, because they saw how shady everything was happening. I mean, there was a lot of shady, scandalous stuff happening. Borderline kind of like the Wolf on Wall Street type, kind of like, if anybody's seen that movie, it was kind of like that kind of money just getting thrown around and bets being placed on things. It was almost unbelievable. But when the courts came out with these things, they pretty much validating those. So it was interesting. Exactly. And then, of course, when that came out, then CZ had to get slapped on the wrist for exposing it, because another thing that FTX did expose was a lot of political donations to certain party members and stuff that came out through FTX. And then that was an eyesore, because now it looked even worse from a political standpoint. And then CZ basically was told to step down as the CEO of Binance. He's going to serve 3 months in jail. And that was pretty, but when he did that, he stepped away. And ever since then, in my opinion, Binance has never been the same, because at that point it's been taken over. It's taken over, controlled by, I'm not going to get into it, but Binance has already been compromised. It's not the same Binance that CZ was there when he was running the show, in my opinion.
True. Alrighty, we're going to turn time to the future just a little bit here. So back in the early days of us over at DGen Roundtable, March 2023, USDC, that's right, that one, had a slight depeg during the Silicon Valley Bank and Signature Bank collapse. Both Signature Bank and Signature Valley Bank collapsed at the same time. And there were some very odd things that happened where the US government kind of did a secret overnight deal where they sold it to JP Morgan Chase to effectively pick up the falling pieces. But what happened was that Circle disclosed they had about $3 billion of USDC reserves that were held at Silicon Valley Bank, which went into FDIC receivership. And then at this time, this was more of a legitimate market psychology effect here, because this is people looking at what they thought was a very secure stablecoin potentially not being as secure as they thought, and some of it might be sold off at cheap. So a lot of people actually at this point traded out of USDC into Tether, and then there was so much it actually caused USDC to briefly trade at about 90 cents on the dollar at some places. Ultimately, the peg was restored after the U.S. guaranteed the SVB deposits, but this is one of the big ones that actually highlighted off-chain banking exposure as a systemic risk to stablecoin exposure. Pretty much not total collapse, but this is actually one of the few near misses that we actually have on the list here, and this was honestly one of the final nails in the coffin when it comes to medium and small size banks here in the United States. At this point, really the only people in the game were the large banks inside of the United States. And it had such an effect that it actually affected the stablecoin market, which theoretically is supposed to be pegged 1-to-1 to the US dollar. But without a backing and just the guarantee of Circle, that was enough to cause investor panic and actually exiting the market to the degree where the asset itself was being sold at a slight discount.
And just to add a little bit more to that, those smaller banks, they were notorious for funding a lot of the crypto investment projects. So some people believe that they were taken out because at the time, you got to remember, the SEC and everybody was very anti-crypto. So it was really interesting that the main banks that were funding a lot of these crypto organizations or projects got taken out. And then, of course, they couldn't pay back. So they got liquidated. JP Morgan and other banks picked them up on pennies on the dollar. So that happened. At the same time, around that time is when BlackRock and others started getting heavily. Now, do they own? Not necessarily own, but own is a very fuzzy word. But BlackRock manages Circle's reserve fund, right? And the government money market fund holding about 90% of USDC reserves, worth about tens of billions of dollars. It's quite a bit. And so there's this whole notion that this was really to try to get Circle and crypto funding and everything to kind of get the banks really, involved in the crypto and really start taking over certain things because of the threat that crypto posed at the time. Still does, obviously, but this you got to remember, like we're talking SEC, everybody, they don't want to call it they're fighting it. So this was just another fight that was taken out. So crypto was being battled quite a bit. So just other caveats to that whole reasoning why some of those banks were targeted.
Exactly. Alrighty, turning back the time a little bit here. June of 2021, we had Iron Finance and the Titan token collapse. A partially collateralized algorithmic stablecoin system collapsed during bank run dynamics, similar to the Silicon Valley Bank thing, but slightly different because there's another crypto token involved in this one. Pretty much what happened is Iron Finance relied on both USDC collateral and Titan token backing. What happened was there were a large amount of redemptions that started to trigger a death spiral, revealing that Titan itself was actually hyperinflated, and this destroyed the confidence enough in the peg that ultimately the price went from $60 to near $0 in a matter of hours. The estimates for this one is that there was about $1 to $2 billion in value that was wiped out, and it kind of is a precursor for a warning about stable coins and how fragile they are. And this one is the precursor to the Terra, which Jane Street Capital was involved in on that one.
Yeah, this is when, in theory, the algorithmic stable coins, in theory, can make kind of sense, but this is where it showed their flaws and it broke. I know. I remember Richard Hart talking about this one a lot and stating, why this was not a very good tool, things like that. And not to say it was necessarily they're incorrect. It's just that the way that they're setting them up, that you can't. But it's interesting, if you all go tie them all back to everything, it always kind of comes back to the liquidity. Yes, they could be doing smoke and mirrors and misleading investors and stuff like that. I mean, they had some big investors. Just go back to FTX. There were some big investors there. There was something called what's the company that Giselle and Tom Brady own? Because they got tied up into the FTX scandal. They lost like $650 million. It was a massive amount of money. Oh yeah, it was. But I think they were one of the top 10 or top 20 holders.
Ooh. Yep, that'll do it.
And they were like Angels. I think their company was Angels something. I forgot what they were called. But they were one of the top 20 or top 10 hold. I'll find here in a second. But anyhow, long story short, a lot of these come back to that. That's the problem with a lot of these. It's just that the liquidity tends to be a problem. And once again, you're trying to build a fragile industry. In theory and conceptual, all this stuff makes sense, but then you have different you have greed that gets in the way. You also have it being a threat to the financial institutions. Certain politicians have their alignments to the bank, so you throw all this into the mix and there's a lot of different things coming at you. Yes, this administration is now more crypto friendly, not to say that can't change the new administration or anything. I mean, it's always changing, right? So you never know what to expect in this. But once again, the crypto industry still has such a low liquidity that makes it a huge, very vulnerable and highly volatile market, regardless. And that's something everybody always has to keep in mind. This is such an early portion of it. So.
True. Alrighty, next one here for you. Going back a little bit further. Looking at our friends up in the north there, up in Canada, they had a central exchange called Quadriga CX. This one is an exchange that abruptly collapsed after their founder's death, leaving their customers' funds inaccessible and possibly misappropriated or mismanaged. Their founder, Gerald Cotton, reportedly died in December of 2018 while holding the sole access to private keys controlling cold wallets. The internal controls on the centralized exchange were basically non-existent, and later investigations actually revealed that there was commingling and potential misuse of the customer funds. What ended up happening on this one was that customer assets were just unrecoverable because it was in the cold wallet, and the guy that knew the password, died and didn't leave any way to get after it. It became a very early study showing that there is custodial risk and governance failure possibly behind this level of centralized control, because if you centralize all of that knowledge and wealth and information and access in one place, or one person that has the knowledge and the keys being themselves, it means they're kind of locked up forever. Granted, this one only came in at about a whopping $200 million USD, about over 250 for Canadian dollars. But at the same time, 2019, we're getting closer to the early days of crypto there. So less about liquidity, more about just, big crypto exchange failure.
Right. And just an update. So the time Red Giselle one, I think they lost anywhere between $45 and $70 million. So it wasn't the 600 I thought, but I could have sworn, I know they were invested heavily into this at the time, but still $70 million. That's peanuts compared to what I stated, but still, it's everybody else out there. That's the tough loss, man. That's a lot of money. Then again, those two, they probably made that back within a year. So
True.
I'm not really feeling sorry for them by any means.
I just got to win the Super Bowl. You'll make it back, right?
Yeah. Oh, well, on a side note, she made more than he did.
Also true. Yes. Alrighty, yeah, we're down to our.
They're not
at all.
Money, that's for sure.
All right, we're down to our last two entries on the list. These are some of the OGs of crypto exchange failures. Coming at number 2, back in 2016, we have the Bitfinex hacks or Bitfinex hack. This is one of the largest exchange hacks at the time, and it involved 120,000 Bitcoin. So at the time, that was probably a couple $100 million. Current prices, that's well into the billions. Pretty much what happened is that attackers exploited vulnerabilities in their multi-signature custody agreement with BitGo. This allowed them to make unauthorized withdrawals and then from there do whatever they wanted with the Bitcoin, namely put it through mixers, offshore it, all kinds of stuff. $72 million at the time. Bitcoin fell about 20% immediately, and their socialized losses across users was a big one that eventually they did repay customers through, but they used Bitfinex tokens or the BFX token. So a lot of unhappy people about, well, I lost it at this time. You gave me what is a equivalent amount, but is it truly equivalent? Was it then? Was it now market prices? That kind of stuff. So shifting away from liquidity back towards definitely what I would argue this is wild west of crypto era. This is 2016. This is pre-2016 bull run. And yeah, just a good old just hack of the wallet there.
Yeah, that was some shady stuff. Have you brought up Mountain Gox yet?
No, that is number one,
Okay.
baby.
All right, hold on. All right, we'll go ahead and finish Mountain Gox, and we'll talk about why both of these
Similar
were
story
so.
here.
This one and that one are so bad. Go ahead and finish Mountain Gox. It's great.
Correct. Mt. Gox, colloquially otherwise known as the Magic the Gathering online exchange, was a platform originally created to transact with Magic the Gathering cards for their online client. They did accept crypto, one of the very first people in crypto to ever accept it. As a result, I think you can imagine that the desire for trading crypto much overtook the desire for people to, play and trade Magic the Gathering cards. So that's how they eventually became the first and foremost centralized exchange when it came to crypto. This one, they suffered a plethora of security breaches and internal control failures. Approximately 850,000 Bitcoin were reported missing. Later, they did recover about 200,000 of them. So our grand total here is still 650,000 Bitcoin. Pretty much what happened was weak accounting practices, bad wallet management, and they didn't react to the breaches very quickly, which allowed the losses to start stacking and stacking and stacking. The Bitcoin price dropped sharply in early 2020 or 2014, and confidence in centralized exchanges deteriorated significantly because of this one right here. The event became the foundational case for exchange custody risk, accelerating industry shifts towards proof of reserve discussions and improved security practices for cold storage and online storage. And the regulatory scrutiny that came not just from the US, but also a lot of other countries internationally, especially Japan. So, yes, there you go. The granddaddy of them all, Mt. Gox 2014, baby. And I am curious about this one. I'm gonna you go for it. I'm gonna pull up the monthly chart to figure out what the price was at the time. I want to see.
Yeah, I looked at it. Based on today's prices, it would be $58 billion is what 850,000 Bitcoin would run today. So it's a big chunk, especially with the market cap being a lot small back then. But so the messed up part about it all is both of those, Mt. Gox and that. Yeah, they finally did say, oh yeah, we're, back in, they started reimbursing payments to people. But it was so bad because they were only giving you the equivalent of what the money or the positions were worth back when it happened. They're not giving the money. So the question would be, cool. So who's got all the Bitcoin then? Who profited off all that? Because somebody made out like a massive amount. But hey, and Mt. Gox was located where? Was it in Korea, Japan? Like where was Mt. Gox located again?
I think it was in Japan. Let me find out for you. But yeah, my quick napkin math here. At the low end, assuming 650,000 Bitcoin and roughly a $300 price in Bitcoin at the time, sounds nice, right? That comes out to about $200 million. Assuming the full 850,000 and a more aggressive $500 price from earlier in the year, that comes out to a total that's about $450 million. So overall, absolutely massive. And by the way, Mt. Gox looks like it was headquartered in Tokyo. Yes.
Yeah, it was.
Yeah.
Yeah, I mean, somebody made out like a bandit. Somebody had sitting on a massive pile of yeah, it's so Mount Gox. I mean, Mount Gox is what pushed DeFi so heavily.
There you go.
I mean, essential exchanges, man. You needed to go somewhere. That's why people are essential exchanges are such a threat. Um, it could be intentional. It might be bad, poor security practices. It doesn't matter. It just means that central exchanges are always going to be vulnerable because of how much money they're sitting on. And they can only, anytime you're sitting on a large money, you're a large target.
Absolutely.
And then some of them will say, well, because these crypto is a threat to the financial institutions. Then you have these, the conspiracies out there, whether you believe them or not, where the financial institutions might be, involved in taking these causing these events to occur because they don't want the threat to happen too. Not saying it's happening or not. Just saying though that once again, crypto has such a target on its back, and it's because it's such a disruptive tool that's causing so much threat to traditional finance in a lot of industries that a lot of people look at it as a threat. So it does have that target, has the target because you have just regular hackers that want to get a hold of it. And because we think about it, because if you hack it, it's not like stealing money from a bank or something. If you hack this money out of a central exchange, you can send it to mixers and start and go on that route. You can essentially work it through and you can essentially launder it that way. Much easier to do in other countries where there's no jurisdiction in certain countries, like specifically Russia and China. I'm not saying that that's it, but those are the threats. What I'm trying to bring up is, yeah, crypto's got a lot of it's a lot of landmines out there.
True. But the important thing that the reason that we went through our little history, the timeline, if you will, of all the various failures, there were a handful of different factors that went into each of the failures, whether it's the super old ones and it just comes down to basic security, whether it's through hacks, theft, or in the case of the Canadian exchange, where you have the security so good that when the founder dies and he takes the keys with him to the grave, well, he also took your customers' funds. Later on, we start getting into some more advanced or more accounting based issues. That's going to be stuff like Terra Luna, FTX, the Titan one, which is that you can have a stable coin that depegs. You can have a token that's hyperinflationary. You can have bad actors inside of your own system that are doing market manipulation and artificially boosting prices. At the end of the day, though, the thing it all keeps pointing back to is that there is a single centralized point of failure when it comes to things that are this large, and that is centralized exchanges. It's not saying that because centralized exchanges exist, therefore losses happen. It's just saying that when you put all the money into a pile, a single ember can burn the whole thing down, which is what we've seen in a lot of these. And in my personal opinion, the Silicon Valley Bank one is also an especially interesting one because that was outside forces that affected the bank. It wasn't anything internal to what's going on with the crypto itself. It was outside forces of banks that were backing crypto projects. And because the bank itself failed, it had risk on crypto as a whole. So these things are evolving as we go through time. Granted, we haven't had major collapse recently, knock on wood for that one, but we're now at a point where we're stacking more money than we've ever stacked inside of centralized exchanges. And that's A, through just straight spot crypto, or through exchange traded funds, the ETFs, their derivative products, all that kind of stuff. All those things have a custodian, which, by the way, is usually just Coinbase. So am I kind of staring at Coinbase on this one, seeing like, you going to be good or is this going to be an issue? At the current point, I happen to think that Coinbase has learned from a lot of these things. There are enough protections in place. And I think that the overall average IQ of the central exchange folks and also the regulators on the outside trying to keep these people in check has gotten to the point where it appears to be a more stable market. I'm not going to say a perfect market, but it appears to be more stable than where we were back in 2023, 22, the late teens, or even back all the way to Mt. Gox in 2014. We've come a long way, but granted, at the same time, crypto's only been around for like what, 27 years, I want to say, or 17 years. Yes, that's how math works. So the overall story is like, look, there's a reason we talk about central exchange exposure when it comes to you using your own crypto. There have been failures. I imagine there will continue to be failures. Hopefully they get more creative with the failures and there's less customer funds that are lost in the process. But I think the track record points to something here, which is that whenever there is a single point of failure inside of a centralized exchange, whether it's bad actors on the outside trying to physically get their hands on it, or people inside the house making bad moves, or people that own the house making moves that affect the house, it all comes back to this one thing. Am I saying that centralized exchanges are the root of all evil here? Absolutely not. They provide a much needed service at this current moment, whether it's onboarding or providing basic market making functions. But at the same time, they're not necessary forever because DeFi has the way to do it. And as it stands right now, there's just no good inroads or outroads when it comes to crypto and real money that you can use for, like, paper dollars. Got one right here for you. That kind of stuff. So just interesting things to point out and keep in mind as we move into the future.
No, it's all well said. All good stuff. Yeah, I agree completely on all that. It was good stuff. Moonpill, that was pretty funny. He's just like, they hate us because they ain't us. And he said basically it's all going to zero. Here's what I look at it.
Says our presentation is the proof that it's all going to zero.
Yes. But this is a highly disruptive. You're taking on the financial institutions, right? You're a huge threat. I still feel like the entire crypto industry has been going through this big, I'm going to call it a simulation, but it's like you said, 17 years, whatever. It's been around for a while to see what's working and not working. But what has changed the most? Regulators have gotten behind it. Large governments have started acquiring it, looking at it as a hedge. It has also led to the technology that they really are attracted to. Like, a lot of people are attracted to the technology, especially with smart contracts. I think that has everybody very, very interested in what this could do, because they're looking at it from a standpoint. They know that crypto could be a threat, but they're looking at technology that could actually, they could profit and make a lot of money on this, because it could cut a lot of overhead and cut a lot of things out of the way for them. And then the governments love it because it will allow them to basically have more control in place. So they'll be able to control when dollars and money's moving around, which none of us like, but unfortunately that's how governments want. They want more control. This is going to give them that control. And so the technology is coming, whether everybody likes it or not. It's coming like a freight train. And with that being said, there will be people that make money. You're going to get a lot of volatility like this because it's highly disruptive. But once things start settling down, you're literally seeing the infrastructure getting put in place. Like, more stuff has happened. Like, it's interesting. If you look back at all the craziness that you talked about, yes, in the three previous cycles, that was a ton of money to be made, right? Because that was such early adoption, but extremely high risk, because well, for all the things you just stated, right? All of those things, and plus thought people weren't sure about it. It was highly skeptical. People can make a lot of money. But now, over the last, since like 2021, 2022, now you're moving into more of a growing, maturing market with the regulation being put in place, and actually looking at this to where it's now grabbing the attention at Davos. A lot of people in Davos were talking about it. Those are the world leaders. Those are the big market makers in the world that are looking at these tools to see how they can leverage this technology and to benefit. I mean, it's full circle now. So we've come a long way. I mean, certainly in the last 2-3 years, we've come a very long way from grabbing everyone's attention. It's just that, market makers and manipulation, which comes back to what we need to do. We need the freaking crypto bill. We need the clarity to get that out of the way.
I thought you were going to say it comes back what we need to do, which is finish the article that you pulled up in the beginning.
Oh, sorry, man. Yeah, go ahead. Sorry.
It's all good, because I got that one ready to go as well. But yes, you are correct as well. Alrighty, so back to our article from Forbes here about Jane Street. The India playbook. The Terraform allegations are unproven, but India regulators have already reached their own conclusions about Jane Street and their trading practices. In early July of 2025, they issued an interim order against 4 Jane Street entities, barring them from their securities markets. The 105-page order accused Jane Street of manipulating Bank Nifty and Nifty 50 indices across 18 derivative expiration days between January 2023 and March 2025. They calculated total profits of roughly 4.3 billion with a B dollars. The regulator described a two-phase strategy, calling it an expiry day trap. Expiry day is expiration day, and it's referring to options contracts, by the way. In morning sessions, Jane Street entities would aggressively buy index stocks and futures, often accounting for more than 20% of market volume in the individual securities. This pushed the index higher. In the afternoon, they would reverse course, dumping their positions. The index would fall back down. Short options positions built during the morning phase became profitable during the decline. In a single day, January 17, 2024, the strategy allegedly generated 735 crore rupees. That is that's probably roughly a couple $100 million. Trying to do a quick conversion there. SCBI described the trades as sharp, large, and aggressive, creating a false or misleading appearance of market activity. When their stock exchange issued a written warning in February of 2025 telling Jane Street to stop, the firm acknowledged the letter but continued the same practices, calling this egregious behavior in clear disregard and defiance of the explicit advisory. Jane Street dismissed their probe as biased and predetermined. It appealed to their appellate tribunal. The hearing was adjourned in February, and the same week, Terraform lawsuit was filed in New York. SEB impounded all of the money there, approximately 566 million in unlawful games. There you go. There's the other lawsuit coming on in New York right now is actually arguing a very similar strategy going on with ETF products. This structural similarity takes on added weight given Jane Street's current role in crypto markets. The firm was one of the original 4 authorized participants for BlackRock's iShares Bitcoin Trust, or IBIT, the largest spot Bitcoin ETF, and remains one of 4 approved for in-kind creation and redemption of shares. The most recent filing showed roughly $790 million in IBIT shares as of the fourth quarter of 2025, but as former hedge fund manager Michael Green noticed, that position is almost entirely offset by undisclosed options and futures positions. Anyone posting this as bullish is committing a capital offense, they said. Current disclosure rules require reporting long equity positions, but not futures, swaps, or most over-the-counter derivatives. Jane Street's actual net exposure to Bitcoin is unknown. The SEC has proposed expanding beneficial ownership definitions to include cash-settled derivatives, but that rule remains unimplemented. So, quick synopsis of this one. This is part 2 of what we're seeing here. Heading back over to Twitter here. Got a pretty good explanation here from Bull Theory. Saying Jane Street's secret trading technique is to accumulate shares, then dump them in seconds to crash the price and profit from short options. They ran the same 10 a.m. manipulation algo in Indian markets and made $4.2 billion, which led to a temporary ban by the board in India. Here's the playbook. Have billions of dollars from investors, buy spot Bitcoin at roughly 68K, open massive shorts against the position, sell that spot Bitcoin you just bought. This will drop the price to about 62K. At this point, those option contracts you created are now in the money and can be redeemed for profit, which, because it's options, it has more leverage, so it's going to be worth more than the drop in crypto is. Close your positions while losing just 5% on your spot positions, and then buy back up the Bitcoin again at 62K to squeeze shorts that were created after you and to create FOMO and push the price higher, and then rinse and repeat, do it all again. In India, Jane Street made more than $560 million frozen in an escrow account manipulation that way. The manipulation case in New York is ongoing. So
it's just that, man, people want to bash a good honest living, man. That's all they're doing. No. Oh God, it's so funny. It's the absolute. So here's the thing: both sides are going to be correct. Yes, they highly manipulated the money. They highly manipulated the markets. Yes, government's going to step in and they're going to find these people and they're going to confiscate their money. I don't know how much will go back to some people that might have this lawsuit in place, but who knows? Maybe these funds will help fund the crypto reserve, right? Maybe they'll use these funds to support the crypto reserve. So both parties are going to basically be taking money. How much does it go back to the actual people who lost the money? Probably nothing at all. But what it shows you is this is how you can get these trading ranges where they can just pump, dump, which is kind of interesting because if you look at the current markets over since the last, 3-4 weeks, we've been in the sideways trading, right? I guarantee this goes on in the markets all the time. It happens. It just goes in, pumping and dumping, pump and dump, pump and dump, and that's all they do. And by the options market, you can do this all day long. Once again, these tools were not available until the ETFs came out.
Well, specifically when it comes to Jane Street, they did not have as much access and opportunity until the ETFs came out. So to kind of put the final bow on this story, pretty much Jane Street, we talked about the centralized exchange failures because it shows that they have traded on insider information in the past to their benefit and detriment of others. The India case shows that they have done market manipulation in other markets. And then the third piece here is the ETF piece. What they have is access and opportunity and a track record of what I would argue are dishonest business practices in the past, showing that have people noted some odd things going on in the market. Yes, in fact, our friend Ash Crypto here, he's saying this is unbelievable. Before Luna sued Jane Street, Bitcoin used to dump after the market opened. And today, even with war headlines, Bitcoin is up $2,000 in just 40 minutes. That's why we want the crypto market structure bill, is it'll reduce manipulation by 70 to 80% and send crypto markets to new highs.
I don't know where he'd get 70, 80%. I don't know how he can justify that. I'd love to know how he's coming up with that concept.
I would as well.
Because here's the thing, though. If you want the crypto markets to be unmanipulated like this with TradFi, then get TradFi out of crypto. It's not going to happen, of course, because they've already got their tentacles in this. But that's the problem. Anything TradFi touches, they screw it all up on purpose because they can make a lot of money by doing this. But you don't have a healthy market. You don't have a natural market anymore. You just don't. Because once you introduce this now gives them the tools to do puts and calls and those, call options and put strikes and
yeah, to refer back to the article real quick, the current rules that are in place, it was citing that people in this position and this size do not have to report all of the stuff when it comes to the contract options and OTC counter deals, that kind of stuff. A lot of other things they do have to report through existing market laws and regulations, but it's not all encompassing at this point. And we're missing a lot of the additional regulation that the SEC provides for traditional markets, not for crypto markets. So that's the missing piece here. And when it comes to Jane Street, the stuff going on with the crypto is at this point all alleged. We don't have any official documents, details, evidence so far as that they've been doing this here. But connecting the dots, they have a proven track record of doing some very shady things in the past, especially with crypto. They have another country that has actually barred them from trading in their markets for doing this exact alleged strategy. And now they're in an exact position where they are one of the 4 key holders effectively for this exact product, giving them unrivaled access and opportunity to take advantage of this. And then additionally, we're getting on the ground reporting that these sort of oddities have been observed in the market. So everything is alleged at this point. But if you lay out all the dominoes, it doesn't sound all that crazy.
No, what I was alluding to, I was scared about. For every Jane Street there's 10 more just like them, if not 20 or 30 more. That's the problem.
They might be like them in kind, but Jane Street, I think, is actually kind of unique when it comes to their size and scope and access. Because they're one of the 4 people that actually is able to offer the IBIT ETFs, it puts them in a very exclusive group. But to your point, yes, you're entirely correct, which is that this kind of stuff exists because people think that they can get away with it. What's one of the reasons why people think they can get away with it? Well, they probably know that their competitors are doing something similar. They might just have a different layout, different structure than they do, but the fundamental strategy and some of the tactics largely similar. And in the US, this is stuff that we've seen in the past. You reference Wolf of Wall Street and what was going on there. Yeah, really not all that different, is it?
No, it's not. No, it's not. And the messed up part about it all is, look at what the banks shorting gold for all the time. I mean, this happens all the time. They can suppress price. If you control so much money, you can manipulate the markets and control the price action. That's it. And that's the problem. It's kind of like, in gaming. You can't have a fun game if you have players there that have own everything, because they're just going to dominate everybody with different guilds. I mean, that's the problem. It's just, it doesn't run naturally. It doesn't run. You're going to disrupt. It's going to discourage everybody else. That's what I'm saying. TradFi is the problem. That period. They are the problem.
Yeah, when it comes to trying to do like risk calculations, there's two things you take into consideration: probability and severity. Probability of any given person doing this kind of stuff, I think, is decently high for markets, just because the the size of what you can get away with, that kind of stuff, the ease you can do it. And I'm not saying it's easy, but I'm saying it's within the realm of possibility. The second half is severity, though. What is the total catastrophic outcome of it? When it comes to TradFi, they have largely similar risk as a lot of other folks, but their severity scale is just so much higher because of the magnitude and the size of the amount of money that they can move at any given moment. That's why I'm right there with you, which is like TradFi has done a good bit of, I think they've done a lot of good for the world, but at the same time, it's undeniable to say that it is a perfectly white, driven as the pure snow history record. Yeah, the the, the the facts and the cases say definitely otherwise, but at the same time, it is it is kind of the lifeblood and the current frontier that humanity is pursuing, which is financial markets. And there will always be someone that's the biggest in the game, just happens to be TradFi in this case.
Unfortunately, it always seems like crypto's getting the raw end of the deal.
Well, hopefully not for much longer. The reason I say that is, well, we have yet another update that's kind of an update when it comes to the Clarity Act. So, our market structure bill that's currently held up with the Senate Banking Committee. From Altcoin Daily, the Clarity Act final text is very close to moving forward, per White House reporter. Okay, very well. Cointelegraph, passing a U.S. crypto market structure bill before November midterms is looking increasingly unlikely amid congressional delays. Other side of the coin here. Okay. Update, White House says the Clarity Act talks are still alive. Senate banking markup could hit this month. The March 1st White House deadline came and went, but negotiations between banks and crypto are still active behind closed doors. And then we also have, coming to us from CoinDesk, Bitcoin is stuck in a rut, but JP Morgan says that new legislation could be the ultimate spark. The long-awaited Clarity Act would bring regulatory clarity, boost institutional participation, and accelerate tokenization across U.S. crypto markets. So the update is not really an update, which is the update is that there was a deadline. The deadline passed. We still have nothing. The other side of this update, though, is that we are continuing to get reports from inside of the organizations themselves that the talks are happening. The bill is still going through it. But as far as what's going on with the major players, namely the crypto exchanges and the banks, JP Morgan is really the only one that's provided new additional information here. But at the same time, they've not really answered the $1 million question, which is stablecoin yield going to be part of it? Because that at this point really is the entire argument going on over that bill. Everything else appears to be resolved. Tokenization, DeFi security, that stuff is largely fallen by the wayside. In fact, the real world tokenization, JP Morgan actually mentioned it as one of the things that they are excited about for the bill. So that one resolved. I think DeFi security and privacy might have fallen by the wayside, but we still have the $1 million question to answer, which is stablecoin yield, yes or no?
I don't know, man. At this point, I don't know. I don't know. They're just dragging it, but well, let me ask you this: they pushed it out. The next meeting's been pushed out when? It's been pushed out to.
Let me check the Senate Banking Committee website. But as of right now, I don't believe there's any hard date for the markup, because the thing that has to happen is the markup itself. Senate office building. Nothing at this point. The last markup session was scheduled for January 15th. That is the one we were looking at, but it was postponed. Nothing else is on their calendar at this point. Legislation. Yeah, nothing on the calendar as of yet. So there's speculation and talk. The rumors are flying, but if you look at the calendar, it's not scheduled, but that is the next thing. The bill has to go to the committee for markup and vote out of there. Pretty much what they're going to do is they're going to amend the bill, vote on their own amendments, and at that point, It will go to the Senate floor for a House vote. And then if that is passed, then you have to rectify the discrepancies between the Senate version and the House version. Once those are rectified, it can go to the desk of the president for final signature. So a little bit of a process to get through, but at the same time, is it still possible to get it through before the end of the year? Absolutely, 100%. The question is, are they actually going to do it, or are we going to keep getting what we've been getting since early January? It's now March, and allergies are kicking my butt, by the way. But yeah, I think it's looking decently. Polymarket actually agrees with me on this one. We were looking at this yesterday. It was sitting about 63%. We're now up to about 75.
Right. So question for that. So if they were to take out, because the big bugaboo of the financial banks is the yield, obviously. So if they remove the yield from this act, does that still allow people to yield on stable coins? And or are they going to essentially, if it's not in this, would it default as a ban?
My understanding based on the text would be that it's not a ban on stablecoin yields for centralized exchanges. Or sorry, it is not granting authorization for centralized exchanges to yield on stablecoins. If you're still looking for yield inside of crypto, you can absolutely find that inside of DeFi spaces. I don't think that's being affected by this. What this really is hinging on is centralized exchanges wanting to offer stablecoin yield. The question has not really been answered. They've been doing this kind of stuff for a bit now, meaning that clearly it's legal up until this point, or at least they're not getting sued over it by the SEC as it stands right now. But this is the way to lock it in for the future. It is the official green lighting. It is getting the sign off from the magistrate. It is the official one that they're really looking for. It doesn't mean that you, as a user, can't find yield somewhere in the crypto ecosystem. You absolutely can. But at that point, you're kind of looking at grading the centralized exchanges or the decentralized exchanges yourself, seeing like, are these sustainable ecosystems? Do these make sense? Is this not just going to be a house of cards? That kind of stuff. Oddly akin to some of the failures that we talked about in our timeline previously.
Well, the thing I find interesting is, I mean, honestly, if it's just going to come down to where central exchanges, at least in the United States, are not allowed to provide yield, but who's to say you can't log on to another central exchange that provides yield on your stable coins? I mean, so you could just jump over there and do it in another country. That's what's going to end up happening. Now, on the flip side of this, though, the certain ETFs, I already know, they started this year, actually. So if you own ETFs, they have already started paying out dividends based on, like, so for example, Grayscale has an ETF, ETHE ticker, right? If you own that, so if you own that, you're getting a yield every month now. And the yield is coming from the Ethereum they have staked. So they have the Ethereum already staked. So you're earning the staking reward yields that way. Yes, you're going through a TradFi, but this is a way where I can see TradFi not wanting the yield to be there, because then it makes these ETFs more tractable, because you know what I mean? It's less competition, essentially, is what it comes down to it. But still, DeFi, you could. So that's good.
Yeah, it's kind of one of those things where it's like, it's different in kind, but not in principle, which is stablecoin yield is very specifically the thing that they're looking for, because it is the thing that competes the most with the banks, because it's yield on the dollar. If I'm not saying this is the case, but if the dollar is viewed as stable, that's the thing that I'm referencing there, by the way, inflation is going to continue to eat at the US dollar. If you have a stable coin tied to the US dollar, then that means it is subject to similar forces, namely the inflation of the US dollar. You can fight that by doing things like buying bonds, which some of the centralized exchanges have proposed as one of the ways to back all the stable coins that are inside of their deposits. And if that's the case, then theoretically they can use bonds as a way to kind of offset the losses and also create the attraction for customers. The other half of that is also going to be coming in through fees generated, all that kind of stuff, their own internal trades, stuff like that. Stablecoin yields are different than the other stuff, which is like, if Grayscale is offering yield on their Ethereum, obviously they're staking the Ethereum, so it's very clear where the Ethereum is coming from. And the math makes a lot of sense on that one, because it's like, cool, we have the ETH, it's staked. The staked ETH is generating the new ETH that's going into the payouts. Got it. Simple enough. When it comes to the stablecoin, because we have the Genius Act or the stablecoin bill that was passed previously, there are a lot more provisions and regulations and safeguards surrounding stablecoins and what custodians have to do with it. So that's why this is kind of a different argument when it comes to the yield proposal.
Right. But there's another threat here we haven't even talked about, and that's the fact that how much money has UST frozen from holders? I mean, there's that threat. USDC has kill switches too. So I mean, I'm not trying to go down this and say this seems crazy, but unfortunately, these stable coins have a huge threat to them. I mean, not just the inflation of the dollar, but the fact that these entities can essentially freeze this money for whatever reason. There's been quite a large amount of money from USDT that's been frozen. So those are things you got to be careful of. These are things that you should be at least aware of. And if you don't believe it, go out and research it yourself. You can look at it, and it's happened. So just got to be careful of that. One thing I wanted to bring up. So this whole crypto, people think that cryptos this is where most of the manipulations ever happened. So there was something that happened in the early 1900 happened in the early 2000s. It actually happened, it was known as this massive LIBOR scandal, and it makes these things that we see in crypto like child's play. So what happened was banks worldwide, including Barclays, UBS, Deutsche Bank, Royal Bank of Scotland, and many others, trust me, many others, were included in manipulating the LIBOR, which is the benchmark interest rate used to price trillions of dollars in loans, mortgages, derivatives, bonds, financial contracts globally. And what it is basically, so like a lot of cities and governments were involved in these lawsuits because they were essentially here's a good example, and this actually happened. Let's say Baltimore had a project and they were trying to get funding for this project, and they wanted to build, certain infrastructure. Well, they got this massive loan, right? But that rate was manipulated. So they got a higher interest rate on it when it shouldn't have been, because the way you submit these offers are supposed to be closed bid offers. But what was happening was, and this was all in the law in courtrooms, where they were basically on the phone telling them, like, I think you can come up another percent, another quarter, even though that your other bidders were there, you could come up a little more. You can come up another 0.5%. And there was kickbacks and like, it was funny, like Super Bowl tickets and other, gifts that were given out in order to this thing. And this is all out there. You can read about this, but not many people know about it. It was just crazy. I mean, you're looking at this here was the largest financial manipulation case in history that most people don't even have a clue about. So the LIBOR, I think it's the London something benchmark rate, but basically it sets the entire trading rate for everything around the entire globe. So trillions of dollars are involved in this. So what came out of it was a few guys went to jail. A couple guys got slapped on the wrist. Most people didn't even pay attention to this stuff because it was so dry. Nobody really understood what it all meant. It's what typically happens. But Deutsche Bank, they got slapped on there. It's just minute what they got slapped on. Deutsche Bank had to pay 2.5 billion. Some of the other banks had to pay 1.5 billion or $500 million. That's a joke compared to what it was. So if you're not familiar with the LIBOR scandal, I would highly recommend you go see it. This runs very deep. This shows you how big manipulation can happen at a global scale. So you need to understand things like this because these tactics get used. And if you think about it, these same tactics are happening now. But instead of doing rates, manipulating rates, they're manipulating, slippage. Essentially is what they're looking for. They're always looking for vulnerabilities and an edge. And if they can get away with it, they'll do it. And if they do it, they typically always have a pile of money on the sidelines. So if they get caught, they can tie it up in banks, work out an agreement over long periods of time. Because keep in mind, these LIBOR stuff all happened. And man, most of this stuff took place during, this is all kind of the fallouts of the 2008 crisis, by the way. So most of the stuff that was happening during this time, by the way, it stands for the London Interbank Offered Rate Scandal is what it all kind of rate. That's what it stands for, LIBOR itself. But basically this all happened during the early 2000s, and it wasn't even solved. It took them all the way until 2015, 2012. So we're talking almost 7-8 years after the fact until things were settled. So they can tie these things up for quite some time. Just wanted to bring that to everyone's knowledge because much larger scandal, but this has been going on for a long time. It goes all the way back.
Yeah, something human nature doesn't change. Alrighty, tell you what, I got one final thing I want to pull up here before we start to wind it down, and that is some good news. I know we covered a lot of exchange failures and not super fun stuff here tonight, but bit of good news. The ISM came in. This is the Institute for Supply Management, their manufacturers PMI, or the Producer Managers Index. What we see here is that it's up at 52.4%. If you've been following the show and you watch some of our specials, you know that anytime we're over 50 is an especially interesting number. And anytime we get over 55, things get real exciting. So what are we looking at here? Well, we're pretty much looking at, we had the manufacturer's PMI registered at 52%, and the overall continuation and expansion for 16 months above 47.5%. Overall, it's good news. Pretty much where we're getting to here is that things are growing. And
it's growing, and there's more liquidity getting pumped into the markets. And if more rate cuts do come, that will just keep feeding this to where, and that's what people hear people say, hey, they're going to run the market, they're going to run the economy hot. And what they're saying is they're lowering the rates because it's causing more money to be pumped through the system by doing that. Long story, it's going to devalue the dollar, and things are going to not be as good. But by lowering those rates, it does allow people to readjust their loans, restructure debt. And then, of course, that also causes a massive liquidity to come into the market where they can now start, banks can start lending money out more aggressively, and it'll trickle down through all the systems and down to the average person on Main Street.
True. Yeah. I lost it in my original article, but this tweet I found actually does sum it up nicely. Came in at 52.4. Is that above that 55 number? No, it's not. But the other exciting point here is that the expectation was to come in at 51.8. Well, came in at 52.4, which is fantastic. And if you remember from the last time we covered these, that is also up as well. So this is the second data point in a trend that is starting to build towards the upside. For all the people in the industry, it's good news. For people that are also looking to invest in assets to potentially grow with their capital, this is also excellent news. But at the same time, here's your grain of salt. This is only 2 data points confirming the positive trend. Probably need a third and a fourth, and ultimately we'll have to cross that 55 benchmark. But if you're looking for early indicators, this is one of them.
Just another side caveat, Circle, its stock shares had already moved aggressively with massive volume and buying. So something else to keep an eye on. We're talking about them today with USDC holding stablecoin, but they've been moving pretty aggressively. So that's $60 a share. Now it's sitting at $96 a share in just 4 days.
Not bad at all.
It's a very aggressive move.
That it is. Alrighty, tell you what, that pretty much does it for the news stories here. If you want some of the information that we talked about tonight, in order to get that, you're going to have to hop inside of our Telegram, which, by the way, you can find by heading on over to walktheblockndf.com. From there, you can find the tab with membership to get signed up for our exclusive Telegram, where inside of there, you can find our ongoing chat for everything latest and greatest with discussion about news events, ongoing price, trends, markets, whatever it is. We also have exclusive live streams that we do inside of there for our members, as well as answer all the kinds of questions you have so that we can help you guys build a strategy that works for you. Again, nothing we provide here is financial advice, but we can at least help you understand what's going on in the markets, build a strategy that's going to work best for you so that you can choose to execute on it, and then join the group, start learning, growing together with all of us, because when we work together, we win together. We like to say that the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. Private mentorship, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. Oh, made it through before the sneeze. Excellent. Let's go. Alrighty, that pretty much wraps it up here for tonight. Mr. Tracker, any final thoughts we get out of here? Any of the collapses that really tickled your interest there that we talked about?
No, I just think if you look at it, it's evolving. Mt. Gox was so brutal because it was the first time. And if you think about it, it's where most of the centralized Bitcoin was. So that makes a lot of sense. The unwinding of everything that's happened in the past, that was when crypto was under the SEC regulation as far as being really a huge threat. That's starting to uncover. the bill getting passed. I personally don't care about central exchanges being able to stake stable, early yield. I could care less. Let's get the bill out of the way. Because the reason why we'd care to get that out of the way, as soon as you get that out of the way, the sooner the financial institutions will have clarity. I'm not trying to pardon the pun, but they will have more clarity on what in the hell they're supposed to be able to do with these tools, so they can start providing it to their customers. That's going to bring in more liquidity into the market and so forth. So that's the area that I think most of us in the crypto industry want to see. And those that believe that the Ethereum price and Bitcoin, those prices have been manipulated, there's a lot there, just certainly. Just on the article you did alone, I mean, I think a lot of people do feel that these have been manipulated. Certainly the Ethereum price, a lot of people feel it's been manipulated. As soon as we get this out of the way, then those that are suppressing it, we would expect them to then step aside and let this run, because and the other piece of this puzzle is these institutions that are going to start providing these products to their customers, they want them to do good, right? So they're going to need, if they're going to market this, how are you going to market this if it's not doing anything, it's losing money? They're going to want it to at least move in some shape or form for their customers. So that's what we're expecting it to start to move once they get this out of the way. And at the same time, if PMI is still holding strong, liquidity is coming in, the new Fed chair comes in May, if they were to start, cutting some rates, and even an unexpected rate cut, that could definitely cause a really jump in the market with risk on assets and more of an appetite that could feed into, this year. I know a lot of people feel like, oh, we're going to have more of a sell-off, more of a pullback in this market, and then we might start to go back up. Personally, I'm still in the camp that the more down this market goes, the more bullish I become. A lot more bullish, because you're running out of sellers. People are like, oh yeah, people can dump hard and sell it, but still, it goes back to what we keep saying. Institutions keep buying it. They're putting a floor in, so I'm going to keep holding. And if they want to keep dumping, then we will keep adding to the positions, because we're playing the long game, not necessarily the short, degenerate type plays where you're doing on, certain altcoins that have very low liquidity. There's a time and place for this for your trading markets. Certainly, this ain't the market you want to be doing it in. Certainly, but yeah. So stay patient with everything. Let's get some clarity on this out of these bills and get this thing out of the way. Let's get the stable coin thing removed, because honestly, I could care less. There's still DeFi out there. There's other ways to earn yield. There's other ways to earn staking rewards. So let's get this thing out of the way so we can all start to see some green candles for the first time. And those that are still sticking out, holding it, congratulations on holding out. For those that sold and took some profits at the top, congratulations to you. Hopefully you're trying to DCA into the certain positions.
Well said. Well said. I got to say, one thing that I hope that this show helps kind of preserve is the Silicon Valley Bank collapse. In my personal opinion, that one is getting memory hold very quickly. And even when it happened, it was a lot of cloak and dagger stuff that was swept under the rug very quick. But as long as you remember it, we can still keep pointing it out. But outside of that, yeah, very much looking forward to getting the Clarity Act passed soon, hopefully. But we'll have to just wait and see. It's up to Congress at this point and all the people that are kind of backing it over there. So we'll keep an eye on that for you guys here. But outside of that, that is it for this evening. So until we catch you guys next time on the live stream here Monday, we're going to 9 p.m. Eastern time for the short foreseeable future. But we would love to have you guys back next time. Thank you to everybody that showed up here tonight. Love seeing all the comments. Love seeing you guys show up. But with that being said, we'll catch you guys in the Telegram, or we'll catch you guys here next Monday, 9 p.m. Eastern time, for the show where we cover all the latest and greatest in the crypto news and try to break it down for everybody so we all know what's going on and can start working together. All right. With that said, ladies and gentlemen, good evening. Have a good one. Bye-bye.